Hello everyone, welcome to JIB CIB English Medium. My name is Aarti and I hope you all are doing good. So if you're also planning to clear your CIB in first attempt, then do follow this series and try to solve all the questions because nowadays I'm bringing so many different types of numericals. So make sure you are practicing with the help of calculator and you are solving as well. Yes, so let's start today's session. So first question, is our case study. Let's read it and let's identify the correct answer. ABC Limited is a rapidly growing technology company specializing in cloud computing services. Investors are eager to determine whether ABC fairly valued, overvalued, or undervalued compared to other companies in the industry. However, company does not have consistent cash flows. Its earnings fluctuate due to high reinvestment in innovation and infrastructure. Okay, so here is one company known as ABC, but as an investor, we want to value that company, whether that is fairly listed, over or undervalued. But the problem is, I don't have any proper cash flows. There is no consistent cash flows, and the earnings are also fluctuating due to high reinvestment, innovations, or infrastructure. Now, financial analyst is trying to decide on the most appropriate valuation approach. But direct financial data such as future cash flows is not readily available. Future cash flows are not available directly. Now, given the circumstances, analyst considers using a valuation method that allows comparison with similar companies based on available market data. Now, what our analyst decides that if you're not able to take the direct cash flows, why not to take the comparable companies? Yes, that type of a company which is doing the same business, yes, who is in the same market, same features, same characters they are having. So if we are using some other similar kind of company, then we are using which type of valuation model? Let's find it out. Options are the primary valuation method that should be used in this case: A, discounted cash flow, net asset value, relative valuation model, or fourth, dividend discount model. Yes, these are the four different ways to which you can calculate, but as per the given question, you can calculate only with the relative valuation model. Discounted cash flow requires the future estimated cash flows that you don't have. Then net assets value we cannot use because balance sheet, everything is not given to us. Then dividend discount model, because our equities valuation is not given directly, they are saying to go and compare with the similar kind of company. So we are going with the option C. Correct answer is going to be answer C. Coming to next question. Which of the following is not a characteristic of mezzanine financing? Now this is very important type of financing. In your previous attempts also there's direct question based on this. First option, it provides lenders with equity conversion rights in case of default. B, it is secured by specific collateral to minimize lender risk. Third, it is often used for funding acquisitions or specific projects. Fourth, it provides higher returns to investors compared to traditional debt. Now, first of all, if you are not aware about the mezzanine financing, so let's talk about it. So mezzanine financing is what? Mezzanine financing is a type of debt and equity financing. Means you can say when both the combinations are there, debt plus equity, then that is going to be your which type of financing? Hybrid financing. Yes, because the combination of both the things you can see here. Now it gives the lender the right to convert the debt into equity of the company in case of a default. Yes, this is normally for raising funds for specific projects or to finance in acquisition. So here, which is your correct answer? Why we are taking of mezzanine financing? Here we gives the right to our debt parties, or you can say investors. So if they are not getting money on time, they can convert it into equity. Yes, so it is also typically matures in more than 5 years depending on the scheduled maturities of existing debt in the books of issuing company. So this is the combination of both the equity and your debt. Here you give the right to your lenders to convert it into equity if as a company we are not able to pay them. So which is your correct answer? This minimizes the lender risk. No, secured, we are not getting any collateral things. We are not getting in exchange any collateral things, so this is not the secured option. Often used for funding acquisitions or specific projects, but we need to tell the not a characteristic. Yes, Hmm. Okay, so issuing company, its cost lower. So let's read the full paragraph because they are asking so many characteristics at the same time. Okay, so let's read it. You can see first point, it gives the lender the right to convert the debt into equity. Okay, that is the first point. That is okay. This is also used for raising funds for specific projects or for finance or an acquisition. Okay, and mezzanine financing provides higher returns to investors compared to normal debt instruments. Yes, this is the third one. Now, okay, so let's read it. It provides higher returns to investors compared to traditional debt. This is true. This is not a part. This is a part of your mezzanine financing. Then often used for funding acquisitions or specific projects. Yes, this is also true. And provides lenders with equity conversion right in case of default. This is also true. Correct answer is your answer B, which is not the characteristic of your mezzanine financing, because we are not using any secured collateral thing so that we can reduce the risk. So correct answer is your answer B. Now, what does environmental analysis primarily focus on? A, only external factors. B, only internal factors. C, both internal external factors. Or D, financial performance of an organization. So as you can see here, environmental analysis, they are not talking about only external or internal. They are talking about both the factors, whether that is internal or external, which influences the organization. So correct answer is your answer C. Yes, correct answer is your answer C. Now, coming to next one numerical question, let's solve it together. A company has a stable growth, G, at 5%, return on equity 15%. They are asking about payout ratio. Payout ratio means your dividend payout ratio. Yes, so how to calculate this dividend payout ratio? If we know the earning per share, we can deduct the retention ratio. Yes, we can, if we know the earning per share, we can deduct the retention ratio and you can get this dividend payout ratio. But the problem is we are not getting, we are not having this retention ratio. But how to calculate retention ratio? We know it, because here when formula is, that is growth equal to ROE into retention ratio. This is your RR. We know this formula. Okay, so this formula says that ROE is your 15% and here is your retention ratio. Means if you subtract with EPS minus retention ratio, you can get dividend payout ratio. So this is your RR. So RR is going to be what? That is going to be 33.33%. This is your retention ratio. Now, as I know that dividend payout ratio is going to be 1 minus 0.3333. So dividend payout ratio is going to be 1 minus 0.3333. That is your 66.67%. This is your correct answer. So what we calculated, let me revise it again. Suppose company is your Reliance. Okay, Reliance earns earning per share as 10 rupees. Okay, now from this 10 rupees, Reliance will distribute to their dividend holders, to their shareholders in the form of dividend, and few amount they are going to reinvest in their business as well. Yes, so this dividend amount what they are paying out of this 10, suppose they are paying 2%, means that is dividend payout ratio. And remaining amount they are investing. So what is the remaining amount? If they are paying 2 rupees to their shareholders, what is their reinvestment amount? That is going to be rupees 8. Yes, so this 8 is their retention ratio. So or retention amount, or you can say ratio, is 80%. This is your 20% and 80% is your retention amount. Yes, out of 10 rupees, if 20 you are distributing to your shareholders because you are using their money, so 80% you are reinvesting. Okay, so this is your retention ratio, this is your dividend payout ratio. Now, ROE is the amount which you receive from the investors, and because of that amount, how much you have earned. So as an investor, whatever the total funds I'm giving to the company, by that, what amount they have generated, that is the return on equity. Growth means because of the reinvestment, and with the available funds, how much extra growth we can see. Yes, if we are standing at this point today, how much growth we can see in next year. That is what growth talks about. So this is what we calculated here. I hope everyone understood what we calculated here. Yes. Now, coming to your next question, that is ABC Limited has a return on equity, that is ROE of 20%. Now, required rate of return, that is R, is 12%. Company follows a retention ratio of 60%. Dividend of the fundamentals. Okay, calculate PE ratio of the company. Now here we need to calculate PE ratio. Now what is this PE ratio? PE ratio means if I want to, get the earnings of the company. If I want to get the earnings of the company, how much I am ready to pay for it. Okay? How many shares I am ready to purchase if I want the earnings of the company. Yes. So that is what PE ratio talks about. PE ratio is nothing but your current market price divided by earning per share. For each earning, as an investor, how much amount I'm ready to pay. Yes, that is what PE ratio. But in this question, they're talking about fundamental calculation of PE ratio. Yes, everyone. So how we need to calculate here? So they are asking about PE ratio. Yes, so with the help of fundamentals. So this is equal to 1 minus B divided by R minus ROE into B. Yes. 1 minus B divided by R minus ROE into B. ROE is your return on equity. That is 20%. Yes. R is also given, that is 12%. And retention ratio given, that is 60%. Now this B means what? This B means your retention ratio only. Okay, B means what? Retention ratio. And based on this, we need to calculate the amount. Now, if your retention ratio means if your total earning is equal to 100%, this is your total earning. Okay, this is 100% is your total earning. Okay, out of this, if you are giving 60% as your reinvestment, what is the amount you are distributing as your dividend? How you will calculate? 100 minus 60 means 40% you are distributing here. Correct? So what amount we are going to take for this dividend payout ratio means they are doing what they are doing in numerator 100 minus 60. So this will give you dividend payout ratio divided by R. Yes, so I am erasing here. That is going to be your 0.40. R is going to be 0.12 minus ROE is 0.20 into B is 0.60. Make sure you are calculating very carefully. Okay, please don't take in denominator 0.6. 0.6 is your reinvestment amount. That is your 60%. 0.6 into 0.2. Okay, wait. So if you take this is going to be a 0. So do one thing. Okay, take this required rate as your 18%. Yes, 18%. Okay. So 0.40 minus 0.18 minus 0.12. So that is going to be 0.40, 0.18 minus 0.12, 0.06. So what is your PE ratio? 0.4 divided by 0.06. That is your 6.67. That is going to be your 6.67. Let me recheck this question again. Yes. So just do a quick check, okay, before submitting the final answer. So this is your correct answer. This PE is your correct answer. So this says that, I'm so sorry. Wait. Yes. So as per this, they are saying that this is your final PE ratio. Okay, everyone. So this is how you need to calculate your PE ratio. And finally, if you are planning to give this upcoming attempt and you want to clear in your first attempt, then you can join my this ABFM Telegram group as well. And if you have any further query, you can discuss over there. So with this, now I'm winding up this session. Thank you everyone for joining. Take care and bye-bye.